The designated hour having arrived, I call to order this regular meeting of Ansel Link's Quorum Forum Podcast, the podcast. Local governments need to do business. In the chair, it's me, Daniel J. Bolin. On the agenda today, it's a highly anticipated follow-up to Anatomy of a Redevelopment Agreement. It's Anatomy of a Redevelopment Agreement Part 2. But first, let's take the roll behind the glass. For our protection, Engineer Rick is present, and we have a quorum. Dear listener, in Quorum Forum episode 97, Ansel Link partner David Silverman broke down the essential components and negotiation strategies for drafting effective redevelopment agreements, or RDAs. Today, we are sharing the second part of a training seminar hosted by the Southland Development Authority and the Village of Hazelcrest. While Part 1 focused on the bones of an agreement, Part 2 dives into the real-world implementation, financial math, and the heartbeat of these deals. The talk is moderated by Nick Greifer of the Southland Development Authority and features a powerhouse panel: David Silverman, equity partner at Ansel Link; Michio Murakishi, economic development consultant with the Meach Group; and Terri Cox, senior vice president at Matanke Realty Group, who brings 30 years of rough-and-tumble experience from the developer side of the table. They discuss everything from internal rate of return and gap analysis to the but-for test and protecting the public investment. Without further ado, Engineer Rick, roll it.
So our first speaker will be David Silverman. I just want to remind people, many of you were at the part 1 of this session. This is called the Anatomy of the Redevelopment Agreement. Part 2. Today is part 2. Part 1 was about 7 or 8 weeks ago in Homewood. So we're excited to have another Southland Development Authority event here in Hazelcrest. David's going to provide a recap of what we covered in Homewood 7 weeks ago, and then turn it over to Michio Murakishi.
All right. So, as Nick was saying, several weeks ago in Homewood, I went over the anatomy of an RDA, which will include the things you're going to hear from Michio. Sorry, is your name?
Terri Cox.
Terri Cox. And they're going to talk about kind of like what I would say is kind of the heartbeat of an economic incentive agreement, where you're structuring the economic incentives, clawbacks, things that I've talked about before. So I'm going to be very brief because they are the main event. But when you think about your redevelopment agreement, it needs to be a roadmap for how the project's going to flow, how it's going to come out. And what they're going to discuss is kind of the critical piece of it if you are providing economic incentives, be it TIF, business district, whatever it is. And we work closely with the consultants who do the kind of work to design these incentive models, who test like the developer's pro forma to determine where the incentive should flow in, what the real valuation of the incentive should be. We just do the drafting. They're the geniuses behind coming up with all of that math that goes into that project. But just at a very high level, without getting into the whole anatomy of an RDA, that's what I really want to leave you with. It is a roadmap, and you need to think of it holistically as how this project's actually going to work. Everything from the zoning, the subdivision, the engineering, how public improvements are going to be dedicated, that should all be part of your agreement. The things that you're going to hear over here about the economic incentive piece, how you're going to design like the clawbacks to protect the public investment in the project, how you're going to deal with the fact that the developer typically may transfer the rights of the project to another developer who's not related to them. How is that transfer going to happen? How are they going to be bound by the agreement? Those are all things you need to think about. So that's all I really wanted to say. I'm going to turn it over to both of you and take it away.
Great. All right, well, thank you, everyone. My name is Michio Murakishi. I'm an economic development consultant with Meach Group. For the past 20 plus years, I've been working on public-private deals with mainly suburban communities. I've really had a focus on this one particular subject that we're talking about today, so I'm excited that all of you are here with me. So first and foremost, kind of zooming out maybe to a 20, 30,000 foot level, when we're doing economic development incentive agreements, the question usually is, why is this necessary? Why do we have to give these folks money to make this happen? And the reason is, there's usually only a few reasons why something isn't happening that a community wants to happen. You might have a site on a nice corner, and you're like, why isn't anything happening here? And usually the answer to why that's not happening can boil down to a few basic types of reasons. One being, the simplest is like the zoning is just not right. You want commercial here, but this is zone residential. But oftentimes when I'm involved, the case is, there are market and financial factors at work. And so the reason that you're not seeing a developer come in is because the developer is taking a look at that site, I promise you, and crunched some numbers and said, this is not going to work. And so that's where the incentive comes in. And the guiding principle, from my perspective on underwriting a public-private deal, is you're trying to provide an amount of incentive such that it will make the project financially feasible to a developer. And so what that means, financially feasible, is it means that they're going to achieve a market type of return. Because if they can't achieve a market return, what's the point of making the investment? So we'll get a bit more into what those market returns are, but that's kind of like the bigger picture. We're just trying to make this thing financially feasible. And the golden rule, again, this is from my perspective, is we're not trying to give the deal a penny more than will make it financially feasible, because anytime you go over that, theoretically you're subsidizing excess profit, which is not the place of the public sector. So what I want to kind of focus on this morning is how we do that, and the different metrics we use to measure those returns for developers. The classic way of looking at these deals is think about the way development works. You start with a capital event, which would be the expenditures of the money to develop the project. And you end with a capital event. Someday that asset's going to be sold. And in between, you have a holding period where you're the owner of that property has a net operating income. There's some kind of yield on that. And so to measure that whole cash flow from the beginning of when the costs are incurred to the end when the asset is sold, we look at that entire cash flow on a discounted cash flow basis, and then we measure the internal rate of return. And the IRR is basically just a way to annualize returns of a multi-year cash flow. So IRR is the classic way of looking at these deals. And we usually look at like a 10-year hold period with a hypothetical sale at the end of that 10-year hold period. Another important concept, and I don't want to get too mathematical here, but the IRR, if you use the IRR as a discount rate, you can use that to sort of solve for what the need of the project is. So in other words, I have a cash flow for a project, and I know that the developer, let's just say, has a target return of 10%. In Excel, you can just plug in the net present value formula and add the target IRR as a discount rate, and the result of that equation is the gap. So I think David mentioned this. I mean, it kind of is mathematical in a lot of senses, but obviously there's a lot more that goes into it. So back to IRR. So the big question is, what are those market level returns? You know, it's not like you can open up the Wall Street Journal and say, like, what is the going return for a strip shopping center in South suburban Chicago. Like, that doesn't exist. And so the kind of classic rule of thumb that we use is the target return is 10% unleveraged and 20% leverage. And the difference between those two is a leverage return is taking into account debt financing. So a developer will often use debt as a way of leveraging up their returns. So that return can approach 20%. A lot of times, folks not involved in real estate development say, well, I want a 20% return. You know, that sounds pretty good. But what you have to consider is, you know, real estate development is the riskiest form of real estate investment. You know, if you wanted a guaranteed return, you might be more interested in looking at kind of like seasoned shopping centers with, you know, Walgreens as an anchor or some other type of traditional store like that. And so just important to note that those returns seem high, but that kind of is what the market return is, especially when you add leverage to a deal. So a couple of other metrics that we look at, again, we focus on IRR, but we're also looking at yield on cost, right? Which is simply the net operating income of the property divided by the total development cost. So this does not take into account leverage or anything. It's just like, what is the yield on this based on our initial investment? And I guess the rule of thumb on that metric is we look at cap rates. So cap rates, just as a review, that's the asset value divided by the NOI. So the lower the cap rate, the higher the valuation, because you're dividing by that number. And the rule of thumb on that is we're usually looking at like market cap rates for seasoned properties, and then adding maybe a couple hundred basis points to account for the risk involved with development. And then I would say a third metric that we might look at, and this is mainly for like for sale residential deals. So if you have like a for sale townhome project, obviously those aren't income properties, right? So that's just a home builder going out and building homes and selling them as they build them. And so for those, we're looking more at like a net profit margin. So that would just be, you know, the net profit divided by the total development cost. And those tend to be anywhere, you know, between 7, 8, 9% up to maybe 15%, depending on the market. And I guess finally, the other metric that we sometimes look at is the cash on cash return. So this would be the yield on the property or the NOI divided by whatever the equity investment is. This is more of a concern for actual investors in a deal because they want to know, you know, what am I getting back on this investment I made? So those are the primary metrics that we're looking at when we're trying to size economic development deals and trying to size incentives. The fourth metric I want to mention is actually probably the most important metric, and that is what I call the net public benefit. So, you know, I've talked a lot about real estate investors and their returns, but from a public sector perspective, you know, if a village is going to be making a multi-million-dollar investment in the form of an incentive, you know, I think it's fair to want to understand what that return is to that municipality. And so the way of measuring that, it varies, but I want to bring up an example, a case study that I think illustrates this concept pretty well. And that was I worked on a deal several years ago in River Forest, Illinois, and it involved a Whole Foods, an existing Whole Foods store that wanted to do a pretty extensive renovation. They were also doing a pretty extensive renovation of the entire center. But I guess most people's initial reaction was, well, like Amazon, Whole Foods, they don't need any money. You know, like what's this deal all about? But I think the point was the shopping center was kind of struggling. It was becoming obsolete, and sales had kind of flattened out across the center. And so the way we looked at that deal was we said, all right, let's compare this proposed incentive deal with what would happen if we just did nothing, right? River Forest is a pretty good market. The center was going to stay active, continue to generate income and sales tax revenue, but we didn't expect it to grow a lot. And worst case scenario too, Whole Foods might have left and we would have gotten another tenant without as good of sales. So what we tried to do was establish that baseline scenario of like, what if we did nothing, right? So we said, let's just assume that sales are kind of flat, maybe even decreasing, and then let's compare that to giving Whole Foods, several $1 million to revitalize the center and grow sales at the center. And so the way we structured the deal was, we said, all right, and the developer was Heitman. We said, Heitman, we will agree to an incentive deal, but we get to keep that baseline portion, right? 100% of it. So we're at least locking in kind of the center as it exists today. Then we looked at the incremental growth over that baseline scenario, right? So giving the Whole Foods the several $1 million, revitalizing the center. We said, all right, that incremental part, everything over that baseline, we're going to split. I don't know what the split was, but we'll just say 75% to you, 25% to us. And so we were able then to measure that net public benefit and establish that whatever the incentive amount ended up being, like the village, we are getting a return on this over 100% of our baseline, and then a portion of whatever is over and above that baseline. And I think, to me, what that illustrates is this idea that you never should lose sight of what the dividend on the public investment is, because these deals can be pretty significant, and there should always be a return to the municipality. So those are the main topics I wanted to cover. Terry, did you have any comments on any of mine?
Oh, I have lots of comments. So I don't know how astute everybody is in here. So just like when you say IRR, so internal rate of return, and I know there's a lot of people in the audience that know what that means. Some people maybe don't. So that's why I just said internal rate of return. And then, capitalization. So what's the word capital mean, right? It's your money.
Right.
Okay. So what do I need in order to put my money into something? I need some kind of a return, correct? Otherwise, I'm going to keep my money in my pocket. So then you got to ask yourself, okay, so how much of a risk am I willing to take to do something? So I could buy a Walmart, and that's pretty much what? Like an armchair investment. So I have the Walmart, they send me a check every month, I don't hear anything from them, it works out great, right? Okay. Now, I'm not really making a whole lot of money on that. You got to take a little more of a risk, and I'll do something else. I see this vacant piece of property sitting in this neighborhood, been there for a while, maybe I'll try that. Okay, but if I'm going to do that, I have to make more money, because it's going to take a lot of pain and a lot of effort, and I'm going to need to get, either the city, the village, or the town involved with me to be able to do this and make it work, because it's going to take more money than I would anticipate actually spending just to do a development. And so then that's where you gotta start to work it through. So what I kinda did is I sort of did a little bit of a different perspective. So Nick's gonna hand out some of the case studies. So I did two. One, so I've been with Matanke for 30 years. I handle the sales as well as also development. And this is the first one that I did at Matanke. So that one's Bishop Plaza. And then the second one I actually did with Nick, and that one's in Harvey. Okay? So I'd like to start just first with Bishop and just kind of go over that. And so I know that there's a lot of, people that are working for the cities, the towns, and we have some mayors and whatnot here. And so just to give you an idea as to what it's like to be in the trenches to get these things done, which is why we come to ask for incentives from towns, cities, villages, I'm giving you the rough and tumble. So when this project first started, the company that I worked for, Matanke, they bought the small shopping center, which was next to a Jewel Osco. And so that was in foreclosure, so they purchased it. And so when they purchased it, the first call they made was to Jewel to ask, how is this Jewel doing? And they said, it's doing great, it's a good store for us. So you have no intention of closing it anytime soon? No, we don't. So they made the investment and started filling up the little center. Well, in less than 2 years, Jewel closed their store. Not only did they close their store, but they held it off the market because they said it competed against a Jewel store that they had at 62nd and Western. This one's at 47th and Bishop. To get to 62nd and Western, at that time, this was 30 years ago when I first started at Matanke. It's 2, but we won't get into age. At any rate, you would have to take 2 buses because at that time that was a very walking neighborhood. Most people didn't have cars, and so to be able to get their goods and services, they were walking to these stores to get them. And so you would have to take 2 buses to be able to get to 62nd and Western to be able to shop at that Jewel. So as time went on, and we couldn't talk Jewel into selling us the shopping center, we actually ended up going to the city of Chicago and having them help us. And so at that time, they actually were putting pressure on Jewel, on Target, and on Walgreens because what they were doing is they were closing stores and then just keeping them vacant and not selling them. So they helped us to negotiate to be able to buy it. And Jewel told us, well, if you want to put a grocery store in there, and it was a grocery desert, you're going to have to pay us more money for this building. So, all right, so we did. But then they put restrictions, deed restrictions on it. So couldn't have more than a 20,000 square foot store, could not have a pharmacy or a bakery. Well, at the time, we were actually negotiating with Aldi, so that fit, into what it is that they were willing to let us do, so it was okay. Well, what we didn't know is that Aldi was going to actually go down the street and they were going to buy something from Cold Taylor Bank, which was a historic building, tear it down, and then build an Aldi. So, all right, so then we weren't able to actually do that, so then we had to go back to the drawing board and figure something else out. And so then we came up with Farmers Best Market, but they wanted 32,000 square feet and they wanted a bakery. So then we had to go back again to Jewel, and we had to ask the city to help us because we had to negotiate to be able to get those deed restrictions lifted, which we did, but it cost another $300,000. At that same time, I've been chasing around the shopping center convention, as most people in here are familiar with, International Council of Shopping Centers. I've been chasing them around every time I could to try and get AJ Wright to open up a store there. And they kept telling me, no, we don't want to be here. No, we don't want to be here. So finally, after 3 years of chasing them around, I got them to agree. They opened a store. They had their second largest opening in their chain, other than Puerto Rico, in that neighborhood. The people were lined 3 blocks around to get into that store. So it did very well, and Farmers Best Market did very well, but they decided to kind of change their concept and go into a different type of store. And so then they sold it to a fellow that wasn't quite as experienced, and so he kind of struggled along the way, and we tried to help him as much as we could. And then Supermust Market came in, and then they redid the store. It was already a beautiful store. I mean, they did a beautiful build out. They put, I don't know, $3 more million into it, changed it all around. Well, all the neighborhood thought it was too fancy to shop in, so in their minds, they thought that the prices were higher than anywhere else, and so they didn't do very well. And then along comes Walmart, and that's when Walmart rolled out their Walmart neighborhood markets. And so then they came in. So then we figured, hey, we're finally all set. And then AJ Wright, Marshalls decided not to have that as part of their, flag. And so then they changed it into a Marshalls because the store did very well. So now we had Walmart and we had Marshalls, and we figured, we're all good to go. Now the only incentive that we actually got to do this project from the city of Chicago was a TIF. At the time, there wasn't any money in the TIF, so we had to do a self-funding TIF. And so then when you get that, and you need the money up front to do some of the infrastructure and whatnot, you have to take it to a bank, and then you have to get the bank to actually discount it and give you some money. And so Harris Bank did that, but we only got 75% of the entire TIF money that we were supposed to get. But, it worked out. And so then as it moved along, Walmart opened, what they were trying to do was be able to be grocery stores in the inner city. That's what they were trying to do. And that didn't work for them for several different reasons, but you don't have to get into all that, but it's in your study. And so then Walmart closed, so then Marshalls closed, so now we go into the redevelopment process again. And so now we have Burlington, CSL Plasma, and then we have a company called Aviva. And Aviva actually is a company that they're out of Texas, and they're in quite a few states, but they wouldn't be considered a national tenant. But they actually sell T-shirts, and then they sell the imprint machines, and they sell the silk screening for what you're going to put on there. So we redeveloped it with that, and then the small shopping center has always been filled, and then we put a little outbuilding on the front, and that also has been filled. But this is just to give everybody a perspective as when you're doing these type of developments, how hard it can be, how challenging it can be, and that's why you actually do need some incentives and some help from the towns, cities, or villages that you work in to be able to accomplish it. So the next one is Dixie Highway in Harvey. At the time, Nick was working for the city of Harvey in economic development, and so my client, he owned about 11-acre property that sat shallow for like 20 years, which made no sense because it's right at the intersection of like 4 different communities that all come together. It's visible from I-57, had a McDonald's on the corner that was doing, great numbers, and it's got 55,000 cars at the intersection every day. Now, you would just think, that's not a problem. Something should go here, right? So, all right, take the listing, start working on it. And it was hard to do, but finally, actually, I was able to get Castle Car Wash open, and I don't know how often you guys are at that intersection, but it's a beautiful building. And they spent about $5 million to do it, and I tried to get as much money out of Nick as I could to help make the development happen, and he was kind of tight with the pocketbook. So we did get a TIF, and then we also got a Class A for holding down the taxes. And so in some of the communities, unfortunately, in the south suburbs, they have some of the highest tax rates in Illinois. So, in order to be competitive and to, make it work for, the developer as well as the tenant, as well as the town, you have to take a look at that and figure out how am I going to make this work? Because normally, your taxes, if the property is filled, is going to be passed along to the tenant, okay? But you have to think, well, the tenant has to be able to make a profit. So if the taxes are so high, and they're paying their rent, and they're paying their employees, and they're paying their utilities, are they going to make a profit? So that's one of the things that's really difficult with the south suburbs, because bringing tenants to the south suburbs, and when they see what the tax rates are, their eyes shoot open. So you have to try to figure out how to make that work. And so that's why in most communities that have the higher tax rates, it's important to be able to do the Class A, because if you don't, and the taxes shoot way up, well, you're going to end up with a vacant building again. So, sum and substance of the whole thing is that if we all work together, we can make things happen. But we all have to understand what each person's job is and how hard it is in order to do this. So, so far, I'm not going to knock on this, it's not wood, but we've done pretty good over the 30 years that I've been with Matanke. Most of our projects have gone really well. But it's also because we try to work as close as we can with the community, figure out what goods and services do they want, and then how do we bring them there. And so if it means you got to chase, AJ Wright, I'm around the shopping center convention for 3 years, begging them to come out and take a look. That's what you do, right? So if it means that, you got to keep replacing a tenant because, whatever the tenant is, and just to give you an example of the Walmart, pretty much, 47th and Bishop is a highly Hispanic community. And so they undersized the produce, and then they didn't have a butcher. So everything was packaged meats. And, Hispanics don't really eat that way. But they did get, they were making over $20 million in a year out of 32,000 square foot store, which is $625 a foot, which is a great number for a grocery store. So they were actually having to send their managers to the produce, wholesaler, to be able to go and get produce and bring it back in little trucks because they couldn't keep the produce aisle filled because they undersized it for that type of a community. And then the other thing that they did is instead of setting the store up, so how most stores when you walk in, the shelving all goes this way, and then you have your cashiers that can watch everything that's going down the aisles, right? Well, instead, they set the shelving up the other way for the pharmacy to watch everybody that was going up and down the aisles. So unfortunately, they had a lot of theft. So, when you're going into different communities, it's important to figure out, who knows the most about a community. And usually it's either your economic development people, or it might be a chamber of commerce. It could be the community group that's in the area, or it could be all three. But in order to figure out what's going to work, how to handle it, and who actually lives in that community, and what do you need to do in order to make it safe, in order to help so that, the tenant's going to make it, they're not going to have a ton of theft. You got to kind of communicate with everybody and figure that part out. Whereas if Walmart had done that, if they had met with the Back of the Yards community group, they would have known to have done things a little differently. But, in Walmart, they don't do that. They know it all. So, okay, that's good. But at any rate, now, finally, I think that this will last for at least 10 years or more with the tenants that we've now put in it. So after, 4 tries, it looks like we finally got it. And so always, that's the other thing you have to understand when you're talking about, returns, okay? Just because you actually get something up and running, it doesn't mean it's going to work, right? So you might have to dig back into your pocket, because you're going to have to pay the taxes, you're going to have to pay the utilities, you're going to have to pay the insurance, you're going to have to pay, for security to be able to keep the building secure. Or what's going to happen? You can end up losing all your copper while you're waiting to be able to get the development done, or the next tenant to come in. So, you have to also look at those things too. So sometimes you may have a developer that comes back to the table that just simply says, hey, look, we did all this, everything was going good. Well, now they changed their concept, they're leaving, we got to get somebody else. So we know it's going to cost us some money. Can you guys help at all? So if somebody comes back to the table, you really do need to sit and talk with them and figure that out. And like you said, figure out you don't want to give them too much money because, they shouldn't be making a huge profit off of the town. But at the same time, you don't want to have it where they don't have the resources that they need in order to keep it rolling. We put right in there that we have the right to market it while we're under contract. And so then what we do is we start right away looking for the different types of tenants or businesses that could go into that development. So that way, we're already rolling before we ever close. And so that's one way of getting speed in your development, is to go ahead and start on it before you actually close on it, so that you're ahead of the game. And usually what we will also do is when we take a look at something is right away we'll start in our mind saying, okay, so what's missing out of this shopping center or out of this area? What don't they have? What do you think maybe they need as things change? Because all the areas change. Some go up, some go down, some of the race groups change, blah, blah, blah. And so sometimes, owners that live out of state, they don't realize that that's happening. And so they don't realize why they're losing their tenants. They're losing their tenants because the people that used to shop there are not shopping there anymore. So, if you stay close to, the cuff and you figure that out as you go along, then you have your speed already going. So that's how we do it.
Yeah, I'm just thinking in terms of a recent deal I worked on was Northbrook Court. Northbrook Court, working for the Village of Northbrook, all of us have seen sort of what's happened with malls over the past several years. I mean, they basically, I grew up in the 80s, right? Was the main thing. And malls have just fallen off a cliff. I mean, it hasn't been a slow and steady, it's just off a cliff. And so for Northbrook Court, like, we needed to get something going because this mall was losing tenants daily, it felt like. And so, I guess, where there's a will, there's a way. We went from we didn't have a TIF in place, we didn't have a business district in place. We started in May putting those tools into place, getting the TIF designated, getting the business district designated, while concurrently negotiating with the owner of the mall on the deal. And we had an approved RDA, signed and approved, in October. So that's 5 months. I mean, so these things can move pretty quickly if there's something motivating everyone to do it. But I think the big takeaway for me was, if everyone's on board to get things moving, you can make it happen.
Thank you, Joe. David, you want to come back up to the now is a good opportunity to kind of open it up for everyone that's here. This is a great opportunity. You've got some great speakers, great experts, seasoned in economic development. It's your turn to ask questions. One question I've been dying to ask is just the basic concept of the but for the economic development incentives to development, the project wouldn't take place. So can you talk about that from a legal perspective and then also from a financial perspective on what that means to you?
Sure, I'll start. So that's a concept out of TIF. But for TIF, the project wouldn't happen. The but-for test is actually an area-wide test. A lot of communities, though, also build it into their redevelopment agreements with redevelopers doing projects in the district. And that's not a bad idea because it's basically saying that this investment will never come here unless we have the TIF incentives in place. So that it kind of is a stage setter for everything that follows. But again, it's an area-wide test. So you don't necessarily have to make it a part of your redevelopment agreement, but it's not a bad practice to do so. And again, as I said, it sets the stage for what Michio and Terri have been talking about.
I think it's your turn now.
Yeah, I mean, from a financial perspective, capital is pretty smart and pretty efficient. It will find a way to grow itself. And so if you have a property that is not redeveloping the way you want it to, it's not because money doesn't know that there's an opportunity there. There are people who have looked at that site, I guarantee you. And so, by the time I come into a deal, we're working on an RDA and I'm asked to do a gap analysis. I mean, there's your but for right there. Because what I'm looking at in my spreadsheets is without TIF or without this sales tax assistance, no one would do this project because the returns are just not there.
Thank you guys. I think you guys shared some excellent insight. One question I have is that, we're talking about working in the private sector and the public sector. And sometimes the questions in the public sector are different. I know one of the questions that we may get when offering incentive is, hey, what's the value to the community in this incentive that we're giving to this private developer? So you talk about taking public resources to support a private development. So in your experiences, what have been some of the ways you have demonstrated the value to the community from that private development? How have you shown the decision makers over that incentive that, hey, this is a good investment of public resources?
Yeah, my approach is pretty simple. What I like to do is prepare basically a return on investment analysis for the community that I'm working in. And so a lot of times that's just as simple as putting together a cash flow analysis that says, all right, this is everything that we've put into this site, this is everything that we plan on giving to the developer. That's on the expenditure side. On the revenue side, I'm putting in like, okay, well, this is going to create TIF, this is going to create increments, so we've got that cash flow, this is going to create these new sales taxes, and then add all those up and look at that on a cash flow basis. And what you want to see is that there's some sort of return on investment for that public money.
So also it creates jobs for the community.
That's another important component of it, yeah, for sure. But yeah, I would say my focus is on making sure that there is like an actual financial dividend to the community.
But to build on something Terry just said, we typically will put in there, and you'll actually also see it in your redevelopment plan for the TIF district, if that's what you're working with, or even the business district. The idea of building tax base, creating jobs, lit storefronts, activity on the street, those are tangible things that people can see and understand. The mechanics of a redevelopment agreement can be very foreign to the public. I mean, first of all, it's a legal document and can be dreadful to get through. But it's an important document, of course, because not only with what Terry and Michio have been talking about in terms of doing the analysis, protecting the public investment, that's really the policy aim here. I mean, the tangible stuff is obviously what you want the public to see, but you also have to have the backside with the protections of that investment the community's putting into the project. And if you can demonstrate that you've done a lot of homework, you've done your due diligence, you've hired good consultants who can help you through that process, that's huge. A lot of communities will bulk in a lot of those costs, but they shouldn't, because putting in those front-end costs really does a good job for you going forward.
What's been your experience in acting clawback provisions of the RDA when the developer is not meeting with parameters in their contract?
Use them. It is important to have good clawback provisions. It's important to preserve your lien rights. It's important to be able to specifically enforce the terms of the agreement against the developer. It's important to be able to ensure that your legal costs are going to be covered, so indemnity provisions. But you have to enforce your agreements. I've had a lot of situations where we go into communities, they have a failing project, and they just haven't enforced the agreement. Now, you don't necessarily, and you should have a non-waiver clause in your agreement, that just because we're not enforcing something doesn't mean we've waived our rights to enforce it later on. Because before you even get to that stage, you do want to engage the developer in a conversation. All right, what's going on? Do we need to rethink how we did the structure of the deal? Do we need to bring people in again to think about the financial dynamics of the deal? You want to have that conversation before you actually start getting to like sending threatening legal letters.
More questions? I have another question. Just talk about coordinating all the legal processes. If I'm a city manager, assistant city manager, I need to not only focus on the redevelopment agreement, which becomes its own ordinance, but also the zoning. There might be some other steps. There might be the TIF process, which is its own set of ordinances. Can you talk about how that's all coordinated and when the timing is?
Yeah, it's a sequencing thing. So as I said in my very brief comments before handing off the presentation, is your RDA is your roadmap for the project. So like I said, in there, you are going to have how the zoning goes down, how the subdivision goes down, engineering, everything else. So you negotiate that out, and then you have the process set up. If it's a project of any meaningful scale, it'll probably be a planned development in your community. And you should always be thinking about whether your zoning regulations, be they planned development or straight zoning, make sense for where the community is from a development perspective. But assuming that's all in place, then you set the stage for them to go to your planning commission, have their public hearing on the zoning, make the recommendation. I like everything going down in one night. I don't like sending stuff up piecemeal to the board or city council. Everything should just happen in a single night. The ordinance approving the RDA goes down, the subdivision goes down if there's a subdivision involved in zoning, and then any other approvals that go along with it.
I think we have time for one or two more questions for speakers. Anyone?
I'll take a stab at one. So, Terry, early on, you mentioned how, sometimes big boxes, they still need an incentive in order to close the deal, right? Can you touch upon a little bit more of the public-private partnership, how you're able to make sure that, the community is being shown the benefit when you have a multi-million-dollar corporation that's doing very well, but yet at the same time, need an incentive in order to come to your community. Can you touch on that aspect a little bit better of how we kind of walk the community through that?
Well, that is an interesting question, because usually the multi-million-dollar corporation is going to be the tenant. They're not usually the owner of that building. And so, yes, they want to put a store in there, but they want the developer to be able to sometimes give them a turnkey store. So in otherwise, everything is done, all they're really doing is bringing their inventory and bringing it in, and then opening for business. So when you have that kind of a situation, you have to be able to have the money to be able to get that corporation to be able to come in there and open a store. So it just depends on, if the community really needs it. And if, you can talk to, the actual people that live in the community, and they tell you, yeah, we really want X store, then, in order to get it to come in, these are the things that we're gonna have to do to get them to come in. So it's kind of that simple in a simple way. But, if it is the actual multi-million-dollar corporation that's gonna come into and buy that big box, well, that's a different story. So yes, they're gonna want incentives to come, because it is gonna cost them money to be able to do it. Most of them are listed on the stock market, so they have to give a certain amount of a return to their investors that are giving them the money to be able to do this with. And that becomes a little bit harder to explain to a community that, yes, they might be a multi-million-dollar corporation, but they still got somebody they got to answer to as the people that handed them that money to be able to put in these stores. So if you really want them, this is what we have to do to be able to get them.
Yeah, I'll just add that I mentioned earlier the Whole Foods deal in River Forest, and the sort of guy on the street response was, why does Whole Foods need all this money? Well, Whole Foods was just a tenant, right? The shopping center was actually owned by, I believe it was like the Hawaii State Teachers Pension Fund, right? And so, that's who the investor was in the deal. So yeah, it can get a little complicated, kind of in terms of public perception of these things, but at the end of the day, all parties in a public-private deal need to feel like they're getting something out of the deal, and so it's just figuring out who those parties are and communicating that.
And if I could just add, Dante.
I just had one more question. Because I have you guys here, let me get free. So, hypothetically, let's say you live at a residential development, multi-unit, and there's a question about whether to give the land to the developer as a write-down, as part of the project, or to lease the land to the developer so the village can still have, I guess, some control in the development of that site. I know both come with some pluses and minuses, but I'd be curious to hear your thoughts as to which is a better option for a municipality.
I think it depends on where it's at. If it's on Main and Main, then you might be able to do something as far as lease it, and they still want it. If it's buried in the back of a neighborhood, and it's going to be harder for them to actually get that project to where it's full, I think you'd have a harder time talking them into leasing it. That's just my opinion, just looking on different, areas.
Sorry.
Go ahead.
Oh, so I have a philosophical response to that.
The public sector is not a landlord.
I don't think you want to be in the business of being in landlord management. I mean, you could do something on a 99-year land lease, which may be necessary for the financing related to the private sector financing related to the project, or some other long-term land lease. But again, you know, you're going to be dead and gone when your, you know, future folks have to like deal with, you know, whatever it is. Well, I mean, I guess you might live forever, but assuming you don't live forever, there's going to be people long down the line that are going to have to deal with whatever's going on. And I think when there's two things, land control is really important, but it's also really important to get rid of that land to the private sector and have good agreements in place that protect that land so that if something goes sideways with the project, you can get the land back. And we typically build in things for that purpose when we are giving land to support a project. But I don't think the public sector should be in the business of being too much into real estate, more than they have to be.
A couple of housekeeping things. I didn't do a good job of doing the handouts. There's actually 4 pages. I only gave you 2 pages. So on your way out, just make sure you pick up the missing pages. I just also want to recognize David Augusto here. So David is with SDA and is on our board of directors, and we're glad to have him here. He can provide, if you want to talk to him one-on-one about his perspectives as a developer, especially on things like incentives. And one final question before we wrap up is just, we didn't really talk about front loading and the sequencing, because sometimes you can actually provide more incentives up in the first year or 2 years and then kind of it tapers off. Do you want to speak to that? Because I think that's a way to, you know, basically help de-risk the project, if you will. So.
Yeah, that's true. You just have to make sure if you're going to front load it that you do have really good documents that say how that money's going to be spent. Just, you know, in one of the, I don't want to say the name of the town, but in the south suburbs, they did that. They front loaded it for a grocer to go in.
Mm-hmm.
They ended up taking the money and going to a different country. So, you know, you just have to know that, you know, if you're going to do it that way, you got to set it up so that they're only getting so much money each time they accomplish something.
Right. Performance-based.
Yeah.
All right. Did you have anything
Just to add to that too, you know, it's all about performance, right? So if there is upfront funding, but that is on reimbursement type of schedule. So they submit those invoices and then they get paid that way. And that, therefore, if you're extending upfront costs, you're not stiff with giving the money and then they go elsewhere.
Mm-hmm.
So that's part of the redevelopment agreement terms.
I agree. That's what I was saying. You got to make sure you get it documented. That's why I was pointing at him.
All right. Without any further questions, I think we're going to stick around for a few minutes if you just want to talk one-on-one, but I just want to thank everyone for coming out.
Thank you, David, Michio, and Terry, for those expert insights. If you have questions about RDAs, clawbacks, or any other local government issues, please email us at podcast@anselglink.com. It's time for the Department of Public Works. You can join Katie Nagy and other Ansel Glink attorneys on May 15th, 2026 at the Illinois Township Attorneys Association seminar for sessions on First Amendment audits and board meeting best practices. There's a link in the show notes. Check it out. Before we go, I want to remind everyone to subscribe and leave us a review wherever you listen to your podcast. We prefer good reviews. You can also call the Quorum Forum hotline at 312-604-9185 or find us online at quorumforum.anselglink.com. Can I get a motion to adjourn? So moved. Second. All in favor. The ayes have it. We'll see you next time on Ansel Glink's Quorum Forum podcast.